Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely is Phil Mackintosh, Chief Economist at Nasdaq, to review how policymakers and investors are modeling out the global economic impact of the coronavirus. Good morning, Phil. And markets trading lower today, and I think people are starting to look at valuations a little bit more critically now that we've entered into earnings season.
Yeah, I mean, for the last couple of weeks, we've been saying, look at the COVID data, look at the COVID data. That's explaining why the market's selling off as much as it is. It's explaining why the market had turned around and got more positive. The last couple of days, that's not been so important. And I think that the reason, we've actually seen some pretty good COVID data globally and in the US overnight. It does look like cases continue to trend down, but it's earnings season and there's a little bit of a reality check, I think, coming through the chatter as well, just in terms of how long we might actually be waiting for vaccines, which, that's one of the things that's kind of critical to get us all out and socializing again, is to know that it's safe to be next to people. And without the positive tests online yet and without vaccinations, I think that those two factors are starting to weigh on markets a little bit.
Yeah, if we take a look at our second slide here, you're right, earnings are causing a reality check on valuations. I mean, even if we look at the way the S&P 500 is trading relative to its average.
Yeah, and I think what happened in the early part of March is a lot of people with macro models sort of did top-down estimates to kind of guess at how much this might impact overall company earnings and sort of the GDP, and guessed at where the valuation of the market should be. The good thing about earnings is we're going to be able to look at company by company revenues and expectations of impact and do a bottoms up. But the difference right now between the top down and the bottoms up is about 25% in a valuation sense. So the bottoms up, fundamental valuations are still a little bit high. And maybe that's one of the reasons why the market's been so strong, is that people are still looking at PE ratios and thinking that valuation should be a little bit higher than where they got to in the bottom of the sell-off. Whereas the macro guys, I think, are sort of weighing very big picture outcomes of whether we're back to work in 6 weeks or we're not back to work for 6 or 12 months, and trying to balance those two probabilities and the costs of each of them. So earnings are going to be interesting, and you can see in this chart that the EPS expectations have not fallen as quickly as even CEO confidence. They haven't fallen as quickly as the market valuations from a macro perspective. And they're also expected to bounce pretty quickly, which is obviously one of the macroeconomic models, is as soon as we get another month from here and we start going back to work, that everybody's back to work and everyone's spending and making up some spending. That, as we talked about yesterday, remains to be seen whether we'll have that V-shaped bounce or not.
Yeah, and the other story certainly has to be the oil supply glut that we're facing right now, too. And we can see, for example, why the Nasdaq 100, which doesn't have its exposure to energy companies relative to the other major averages, is performing on or outperforming on a relative basis. That the supply demand picture for crude right now doesn't look too good.
Yeah, despite the fact that over the weekend we got an agreement from OPEC and everybody else to reduce supply by nearly 10 million barrels a day, you can see in the chart that we've got here, the demand side of the equation is coming down by at least that much. This is just US consumption. And you can see gasoline, jet fuel significantly down as people are flying less and less and driving less and less. For a couple of weeks now, there's been people hypothesizing about how much longer we can actually store the surplus supply, because oil for a lot of refineries just keeps coming out of the ground. It's really hard to just stop the production. So a lot of boats would be rented to put the oil into. We talk about filling up the US reserves, which is in the ground. It's really difficult once they're all full to work out how you're going to actually distribute the oil that's being produced. And that's where some people are even talking about prices potentially going below zero, where producers have to pay somebody to go store it somewhere, and storage will obviously be temporary and pretty expensive. So oil prices are back down in the US below $20, which is about where they got when everybody was fearing the worst. So it's not a great sign, even though we've got less supply coming online now.
All right, Phil, thank you so much, as always, for joining us.
You're welcome.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.